So far, 2023 has gotten off to a pretty impressive start, with the S&P 500 currently being up almost 7% for the year. Actually, since October, the market's been seeing a really nice rebound, which, as an article published a few days ago pointed out, has been a really nice rally that no stock analyst saw coming. Of course, this has led to speculation that we're currently experiencing a dead cat bounce, which is a short-lived recovery before a much longer period of flatlining or declining share prices. And although it's impossible to know for certain if stocks are going to continue to rally or if there's about to be another drop again, there has been some indicators that point us to still being in recession territory. And with that, we've seen some good buying opportunities to pick up some stocks at heavily discounted prices. Last month I talked about Arbor Realty, which is a dividend stock that's continued to flourish despite us currently being in a bear market. But the truth is, there are a number of higher yielding dividend stocks out there that have kept growing their dividends over the last year. So in today's video, we're going to take a look at some other high yielding dividend stocks that have been able to keep growing their dividend distributions in our current market. And although there's no guarantee these stocks will be able to continue to keep growing their dividends in the future, it's definitely a sign of strength for these companies. So with that being said, let's go ahead and get started. The first stock that just recently increased their dividend was PennantPark Floating Rate Capital, ticker PFLT. They're a business development company that makes secondary direct, debt, equity, and loan investments to small and medium-sized businesses. They typically invest between $2 million and $20 million into each business, and they make the majority of their investments in U.S. companies. They primarily like to target first lien senior secured floating rate loans, and they prioritize having a lower risk investment portfolio. On their website, they mention how capital preservation and a stable dividend payment are their most important objectives. The company had their IPO back in April of 2011, and their stock currently offers a dividend yield of 10.42%. Since their inception, this company has never cut their dividend, and on top of that, PFLT pays monthly dividends, which is an added bonus. Last week on February 9th, PennantPark announced that they were increasing their monthly dividend 5.6% to now 10 cents per share per month. It's a pretty small increase, and the last time this company was able to grow their dividend was all the way back in 2015. Considering they invest in floating rate loans, which have provided higher returns for other BDCs due to higher interest rates, it is slightly disappointing that they haven't been able to grow their dividend anymore. But PennantPark floating rate isn't the kind of investment you should expect growth from. It's the kind of holding that'll hopefully be able to keep providing a stable monthly dividend. As of the previous quarter, this company has investments in 126 different companies. The weighted average yield to maturity on their investments was 11.3%, which is up 10% from the last quarter and 7.5% from last year. With this growth they've been seeing in their net interest income, it was the primary reason why they made the decision to increase their dividend. Since their founding in 2007, PennantPark's provided over $17 billion in funding to more than 628 different companies. They've only seen 15 non-accruals out of 451 companies that PFLT has provided financing for since their inception. This information from their investment presentation is a little outdated since it's from last September, but you can see PennantPark's investments are pretty well diversified. They're spread across different sectors like professional services, aerospace and defense, insurance, and high-tech industries. 87% of their loans are first lien loans, and the other 13% being subordinated debt, preferred equity, and common equity. To summarize, after listening to their conference call last week, it sounded like the board's pretty optimistic about their ability to grow their interest income in the year ahead. But again, PFLT is not a growth company. They prioritize maintaining a healthy monthly dividend. If that sounds like something you might be interested in, then feel free to check them out for yourself. Up next, we have Oaktree Specialty Lending Corporation, ticker OCSL. This is another BDC that makes investments in middle market companies, and they also provide bridge financing, first and second lien debt financing, mezzanine debt, senior and junior secured debt financing, among other different types of investments. They invest anywhere between $5 million and $75 million in companies with an EBITDA between $3 million and $50 million. OCSL is owned by Oaktree, which is a global asset management firm that specializes in alternative investments. The entire Oaktree firm has roughly $164 billion in global assets under management. As of the making of this video, their stock currently offers a dividend yield of 11.05%. This company also announced that they were increasing their quarterly dividend last week. The 2% increase translates into this stock paying 55 cents per share. And although it doesn't really sound like a sizable increase, if we look at their dividend distribution history over the last 3 years, we can see a really impressive amount of growth for this stock. They've been able to grow their quarterly dividend every single quarter since September of 2020. Back then, their stock was only paying 32 cents per share, whereas today it now pays 55 cents per share. It's pretty rare to see a high-yielding dividend stock grow their dividends this much, so hopefully it will be an ongoing trend for OCSL. It's been a while since I've gone over this stock, and it's the first time I've talked about it since they went through a stock split last month. On January 20th, Oaktree Specialty Lending Corporation announced a 1-for-3 reverse stock split, meaning that for every 3 shares of OCSL that you own, you would now only own 1 share. This doesn't mean you lost any money or any of your ownership percentage in the company. The share price of a stock performing a reverse stock split goes up to correlate with the change in the number of outstanding shares. You might recall OCSL was trading for around $6 or $7 a share about a year ago, whereas now it's currently trading for $19.91 per share. There's a few reasons why companies do reverse stock splits. Some companies do this when their stock share price tanks and they don't want to be seen as a penny stock. I personally suspect that this is what happened to Orchid Island and maybe even Annaly Capital Management, both of which performed reverse stock splits over the last year. But OCSL wasn't struggling with their performance like these other companies were. My theory is that they probably did this because they wanted their share price to increase and thus become more attractive to analysts. Some financial institutions won't rate a stock that's trading for less than $10 per share, and since these firms' ratings can have such a big impact on a stock's performance, I personally think this explains why OCSL decided to do this. In the past, I've also explained this stock's share price performance. As you can see, OCSL was a poor performer for years and they kept on going on this downward trajectory. But in 2019, Brookfield, which is a large Canadian asset manager, stepped in and acquired 61.2% of this company. Once Brookfield took over in September of that year, you can see the share price for this stock grew over 40% up until 2022 when the whole market started to fall. So since Brookfield came into the picture, OCSL has been a much better performer. They're a much bigger BDC compared to PennantPark with 156 different investments with a total fair value of roughly $2.6 billion. So in the end, they've done a really great job in managing their investments up to this point. This last stock is one that I haven't talked about yet, but I've been becoming a bigger fan of it over the last 6 months, and that's Vici Properties, ticker VICI. It's a much lower yielding dividend stock compared to the other two on this list, but it's still above my 4% minimum, which is what I like to look for. But Vici Properties is an experiential real estate investment trust that owns one of the largest portfolios of market-leading gambling, hospitality, and entertainment destinations. They own a combined 48 million square feet of real estate, including 29 casinos, a combined 19,200 hotel rooms, and more than 200 restaurants, bars, and nightclubs. They also own 4 championship golf courses and 34 acres of undeveloped land adjacent to the Las Vegas Strip. Their stock currently yields around 4.5%, which is much lower than what I usually talk about, but it is one of the holdings in my portfolio that I rely on for growth, which is something that every dividend investor should allocate some of their investments towards. Some other lower yielding holdings that I have to supply me with growth include Realty Income, Stag Industrial, and of course SCHD. If we look at their dividend history, we can see dependable growth every year since 2018. Their stock currently pays 39 cents per share, and they've been able to increase it every year since their IPO. The amount they grow it by can vary for each year, and you can see in 2020 they only grew it by a penny, but usually they've been able to increase it by about 3 cents per share every year. You might also be wondering why I prefer VICI over EPR, which is another experiential REIT. EPR offers a higher dividend and they pay monthly dividends, and considering they both own entertainment properties, which could struggle a lot during a serious recession, why on earth would I prefer Vici? The reason why is because Vici has the far superior property portfolio. The company owns some of the best real estate on the Las Vegas Strip, including Caesars Palace, the Venetian, MGM Grand, the Mandalay Bay, and many others. They have a 100% occupancy rating and all of their properties have triple net leases. There's also a couple unique things to Vici that other REITs can't match. For example, the average lease term for a REIT is around 8 to 12 years on average, meaning that's how long of a lease that the tenant signs with the property. But for Vici, they have an average lease term of about 42 years, which is the highest I've ever seen for any REIT. Obviously, you want longer lease terms for your properties since that helps better predict future rental income. Their properties have a much higher average rent per asset, and same-store rent growth is significantly higher than other REITs. The key reason for this company's moat has to do with their large barrier to entry. Ultimately, in my opinion, VICI is a stock that has a lot of good future potential, and their performance over the last year has been pretty outstanding. But be sure to perform your own research and come to your own conclusion before making any investment decision. With that being said, thank you guys so much for watching today's video, and until next time, take care.